The thematic playing out around rising population, rising middle classes, increased disposable incomes, the world of technology and communication and marketing, online channels, you name it. The world's getting smaller and the demand for food is getting so much greater, really plays into the strengths of Australia, which has a great reputation at producing quality food. Yeah, there's probably some standout industries. I think from an investment point of view or a company point of view, you just have to be great at what you do and you're probably going to do well. But if we think of animal proteins, of fresh produce in particular, they're strong areas. And even within that, the sheep and sheep wool story has particularly been a fantastic one. Cattle very strong also, and fresh produce, particularly as they hang off free trade agreements. Table grapes, citrus, almonds have been enormous winners from those developments, and so things look really good in that space. Well, classically, I think for people looking to invest in agriculture, it's been about buying a farm. Nowadays, there are more opportunities to invest in things like a general index or a fund that's putting together a parcel of properties or commodities that would attract a different investor audience. From a farming perspective, it's often been about how do I invite equity and take advantage of things beyond bank debt in order to grow. And that's proved challenging. I think a lot of Australian farm businesses like to run their own show, don't necessarily like to invite that, but we have seen evidence of more joint ventures on standalone structures, for example, that are putting operational investor capability together in particular, that's taken the investment landscape in agri to another level. I think it's a lot about just knowing what your own risk profile is, your investment horizons, etc., in making the right decision about how you would invest. There's an enormous difference, for example, between being a passive investor for yield and buying a physical property and being responsible for production and all the operational capability that goes with that. Maybe more potential reward, but much more complex to execute. The one great thing about agriculture, I think, is how it's getting so better known and close to general consumers and investors in our market. The food story, where it comes from, provenance, and just the passion for food and awareness of those supply chains has encouraged a lot of potential investment that we hadn't seen in years gone by. But really, investing in agriculture as we've seen it has been a long-term horizon that someone's needed to take, and also to have patience and to probably have deep pockets in many respects, is essential in that agri works through often long but sometimes short cycles. And so really to maximise or smooth your potential gains, you need to be in there for a while, not just 1 or 2 years, because that would give you maybe a great result, but maybe a shocker. These things do need to be evened out and smoothed. The other part of that is the concentration risk that comes with a single investment versus one that might be a diversified investment. And what we see in a lot of the customers that we bank in the market is similar to investors, and that is, whilst things might look, for example, fantastic in sheep, as we've talked about today already, you may not want to be exposed entirely to that commodity. And so businesses that have scaled diversity start to offer a much more attractive proposition to the average investor. It's a market that's we find fascinating and rewarding, and so we invite investment. I think, again, going back to just knowing your own risk profile, how does it fit with your range of investments that you already and otherwise would make? Are you doing it for yield? Are you doing it for capital gain? Are you doing it for owning a product? Are you, there are so many different reasons, but let's not get confused. If you're investing because of your passion, is that the right recipe for economic return? Maybe it is, maybe it's not. It often takes passion to be successful in farming, don't get me wrong, but being aware of what can go wrong, knowing your investment horizon and having your expectations right are really important. The other important thing is to take time before you would invest, I think. Understand the markets, develop a network, and actually start to figure out who you can trust, because you will have to trust somebody at some point in getting into the market, and that can be the difference between a good and a bad investment. Australia can definitely grow from its current output. We know that the demand is there. We know that the product and reputation of Australian industry is very strong. How we actually develop the opportunities that go with that, how we operate in comparison to our global competitors, how we work and develop branding and relationships right through the supply chain are all really critical. But by world standards, Australian industry is very good at this already. We've seen rising output from Australian agriculture at around 10% over the last 4 years. We've got that ambition to produce $100 billion worth of output, which is a leap from the sort of $62 billion that we've just seen. And we will see drought impact that output number in the short term. So we know droughts and these shocks will happen, but over time, the industry gets better and better and better. It's really just picking your mark within all of that as to what role you can play. But absolutely, we can get better, but we're coming from a really strong starting point. Being passive means more than ever you have to trust somebody else. So trust is a critical factor. And I think looking for track record in what the potential investment vehicle has been producing, where it's been playing, the stability of the principles and key attributes of that business are really important as well. Something brand new is much harder to judge. Now there may be mitigants to say that that's still a really good investment and everything has to start somewhere. But I think being realistic about yield and just watching the risk return piece of all this is important as well. Like if the market's generally offering 3 or 4%, and your opportunity looks like 7 or 8, you have to really understand why that is. Are you taking a high degree of risk for that return, or is it something else? And understanding that, I think, is really important.